Bitcoin was down by as much as 21.46% from its October all-time high last week, briefly dipping below the psychological $100,000 mark to a low of $99,045. Such a fall likely signifies the establishment of a new consolidation base rather than the onset of a cascading sell-off. Historical market and on-chain data suggests that the current price action closely mirrors prior mid-cycle corrections, where structural participants stabilize exposure and capital rotates within the ecosystem before broader uptrend continuation. The failure to hold above the short-term holders' cost basis of $112,500 has led to a controlled decline, bringing BTC back below that key level and confirming the anticipated retest of deeper structural supports. At these levels, roughly 72% of BTC supply remains in profit, near the lower end of the 70 to 90% equilibrium band typical of mid-cycle slowdowns. This condition indicates that while selling pressure persists, much of the speculative excess has already been flushed out. The $88,500 active investors' realized price now stands as the next major downside reference, aligning with past cycle support zones where capitulation historically transitioned into reaccumulation. While brief relief rallies toward the STH cost basis remain likely, a sustained recovery will depend on renewed demand inflows from institutional and retail participants. Until then, the market is expected to remain range-bound as volatility compresses and structural positioning resets ahead of the next major cycle move.